Topic examines the objectives and tools of central banks and their role in managing economic stability. Central banks are responsible for implementing monetary policy, regulating the money supply, and maintaining confidence in the financial system. Their primary objectives generally include price stability, sustainable economic growth, full employment, and financial system stability. By influencing interest rates and liquidity conditions, central banks affect borrowing, spending, investment, inflation, and exchange rates throughout the economy. Investors closely monitor central bank actions because monetary policy decisions significantly influence asset prices, bond yields, equity valuations, and broader economic expectations across domestic and international financial markets. Price stability is one of the most important objectives of central banks because inflation directly affects purchasing power, economic planning, and investment confidence. Moderate and stable inflation encourages long-term investment and economic growth, while high inflation creates uncertainty and distorts resource allocation. Deflation can also harm economic activity by discouraging spending and increasing the real burden of debt. To achieve price stability, many central banks establish explicit inflation targets and adjust monetary policy accordingly. When inflation rises above target levels, central banks may tighten policy by raising interest rates. Conversely, during periods of weak inflation or recession, they may lower rates and increase liquidity to stimulate demand and support economic recovery. Central banks also aim to support sustainable economic growth and employment. Lower interest rates reduce borrowing costs for households and businesses, encouraging spending, investment, and hiring. During economic slowdowns, expansionary monetary policy can stimulate aggregate demand and reduce unemployment. In contrast, contractionary policy may be necessary when rapid growth leads to inflationary pressure. Central banks must balance these objectives carefully because excessive monetary stimulus can create inflation or financial instability, while overly restrictive policy may slow economic growth unnecessarily. Analysts evaluate monetary policy decisions closely because changes in interest rates influence corporate profitability, consumer demand, business investment, and the performance of different sectors within financial markets. Open market operations are among the most important tools used by central banks to implement monetary policy. Through these operations, central banks buy or sell government securities in financial markets to influence bank reserves and short-term interest rates. Purchasing securities injects liquidity into the banking system, lowers interest rates, and encourages lending and economic activity. Selling securities removes liquidity, raises interest rates, and slows economic expansion. Open market operations are widely used because they provide flexibility and allow central banks to adjust monetary conditions efficiently. Financial markets react quickly to these operations because changes in liquidity and interest rates affect bond prices, stock valuations, exchange rates, and investor risk appetite. Another major monetary policy tool is the policy interest rate, often referred to as the benchmark or target rate. Central banks adjust this rate to influence borrowing costs throughout the economy. Lower policy rates reduce financing costs for businesses and consumers, supporting spending, investment, and housing activity. Higher rates discourage excessive borrowing and help control inflation. Central banks may also influence commercial bank lending through reserve requirements and lending facilities. Lower reserve requirements increase banks' ability to extend credit, while higher requirements restrict lending capacity. During financial crises, central banks may provide emergency liquidity support to stabilize financial institutions and maintain confidence in the banking system and broader economy. Overall, topic highlights the central role monetary authorities play in supporting economic and financial stability. Through objectives such as price stability, sustainable growth, employment support, and financial system protection, central banks influence nearly every area of economic activity. Their primary tools, including open market operations, policy interest rates, reserve requirements, and liquidity facilities, allow them to manage inflation, credit conditions, and economic growth. For CFA candidates, understanding central bank objectives and policy tools is essential because monetary decisions strongly affect interest rates, exchange rates, inflation expectations, and asset valuations. Effective monetary analysis therefore enhances economic forecasting, investment strategy development, and portfolio management across varying market conditions.